A lot of times companies will announce a stock buyback with great fanfare as if they are doing some sort of great service to the investor. The truth is, these are largely a waste of money, and you should often avoid companies which do excessive stock buybacks. In this brief presentation, we're going to discuss four things. First, we'll go over the definition of a stock buyback. We'll discuss why these tend to be a waste of money, what I'd like to see more as an investor, and finally, we will discuss an example of the rare good stock buyback. So the first thing, what is a stock buyback? This is basically when a stock purchases shares of its own company. So a company will buy its own shares and take some shares off of the market. Theoretically, this increases earnings per share and as a result, the price of each share of a stock. The problem is it rarely works out this way. Companies like to say that if there's 1 million shares of a particular stock and the company makes $10 makes $10 million a year, the earnings per share of that company is 10. So that means they're earning $10 for every share of a stock that exists. Not every stock has the same number of shares. In fact, most stocks have completely different numbers of shares. Is this an arbitrary number? It's typically somewhere between 1 million and 1 billion, so there's a huge variance. The point is, though, that earnings per share tends to be steady, so if a company purchases its own shares, the number of shares goes down, and as a result, there's more earnings per share, so the share price should go up accordingly. The problem is, it doesn't work out this way. And there's a lot of reasons why a stock buyback is a bad use of money. The first is that when a company issues a stock buyback, they're basically saying, we have run out of things to spend money on. We can no longer find things to use our money, so we're just going to invest in our own company. I mean, if a company's buying back its own stock, that means it's not building new factories or warehouses or stores or investing in its infrastructure or research and development. It's just buying shares. It's not necessarily a great investment. You're doing that with your money. You're hoping that the company does more than buy shares. You're hoping that it does something with its money to grow and increase profits. And the other problem is that most companies, when they do a buyback, they're so small that they don't reasonably change the earnings per share. A company will typically buy a couple percentages of its total shares. So if a company has 1 million shares, at best you might hope to see 30,000 shares purchased, which is 3%. And the problem is, well, in theory, a 3% purchase would increase share price by 3%. The problem is most companies purchase those shares and then immediately award those to executives in the form of stock options. So when those stock options come into fruition, the executives that were awarded those shares then sell them and they're back out on the market a year later. So when a company buys like a small amount of its own stock, it's usually just giving that money away to its employees. And it's often the executives are pushing for this buyback, award themselves and their immediate underlings shares, and then they just sell the shares. It does nothing for the investor. It just makes the executives more rich. And occasionally this is not invalid. Stock options are good, especially like a tech company that is relying on paying its employees a lot to attract talent. That's nice, but when a company purchases its shares and then gives it immediately back to the executives, that's kind of underhanded. And really, it doesn't help the investor at all. It just helps the executives. So what I like to see with profit is, one is dividends. If the company has more money than they know what to do with, give it to me. If I'm the investor, I want that money because I'm, the shareholder. I don't want the company to purchase its own shares back. I want the dividend. That's what the investor wants. $5 in your pocket is better than the company purchasing back $5 of its own stock. As an investor, it's much more encouraging to see a dividend than it is to see a buyback. It makes you think that the company is more concerned about its investors than about its executives, and that's what you want. You want a company that's operating with the investor in mind, and hopefully those executives are shareholders themselves. So when they're, benefiting the investor, they're benefiting themselves as well, rather than just awarding themselves stock options and then selling those options right away. That's just not good for the investor. And there's some companies out there like that. So you have to be careful, see what companies are being run for the investor, and, the occasional one that's being run for the CEO, you want to avoid that stock. So another good thing to do with profit is to make sensible acquisitions. If a company can't reasonably grow itself, it might be able to purchase important technology or infrastructure by buying another company. That's a good use of extra money. And as an example, tech companies purchase other smaller tech companies all the time just to get access to either their patents, their staff, or, a small piece of technology. A lot of times they're just buying for the staff. This company has 20 great engineers. Let's just buy the company and employ those engineers ourselves. We can grow that way. So that's a good option. And buybacks are only okay when they're huge, when they're so big that the company reasonably can't give away all those shares back. And what we're going to discuss next is an example of a good buyback. So here was Apple's buyback. You can see that, and this will make it a little bit more clear exactly what a buyback is. You'll see that Apple has about 900 million shares. That means the total number of shares of Apple owned by investors is about 900 million. And you can see multiplied by $560 a share, that gives Apple a value of about $504 billion. And here we can see earnings per share here is 39. So in theory, if Apple bought more of these shares, this number would go down. And if this number goes down, earnings per share, if the S decreases, then this number will go up. And since investors like to keep this number pretty steady, theoretically share price will go up too. And the reason this was a good buyback is because before this buyback was initiated over, about the past year, there was about 1 billion shares of Apple out there. Now there's 900 million. Apple literally bought back about 10% of the company. So they bought back about 10% of the company, and that increased share price by about 10%. And when a stock buyback is that huge, it really makes a difference. They literally took 100 million shares out of circulation, and they did that with, like a $5 billion investment. It was a huge investment to make that happen. Actually, it might be $50 billion. They had a huge amount of cash. They were able to buy back such a large portion of stock that, it actually reasonably affected share price. This share, the market cap before, when the market cap was 500 billion, share price was 500 billion. This literally put, a 10% gain into all investor pockets. So it was good because it was so big. And they will give some of these shares away to their executives and their top talent. But there's just so much purchase that they can't give away $50 billion to their employees. It's just not going to happen. And so just to reiterate, there's 5 reasons why this stock was a good buyback. 1, it came with a dividend. When a company issues a stock buyback with no dividend or no dividend increase, that's a warning sign. That's like the company saying, we don't know what to do with our money and we're not giving it to you as the investor. To me, that's like, I don't want anything to do with that stock anymore. Instead, this was coupled with a hefty dividend. Apple went from not paying a dividend to paying about a 2% dividend, and then they went ahead and hiked that dividend already by 15%. That's a good sign. Their company is saying, we're buying back our stock, but we're also giving a big dividend. And in addition, the company had massive cash reserves. So the company had a lot of money, and they didn't really know what to do with it. And they're investing heavily in research and development, but Apple had about $100 billion in the bank. It only made sense for them to buy stock. It really wouldn't have been a great use of money to pay out, 20% to the investors because they'd just be depleting this cash reserve. It made a lot of sense to buy back 10% of their company because when it's that large, it does meaningfully affect share price. And it also was so big that it was able to increase the ability of the company to raise the dividend in the future. So what I mean by that is if there's 100 million less shares, That means when the company goes to pay out its $3 dividend, it doesn't have to pay out that $3 to those 100 million shares. It owns the stock. It doesn't pay itself a dividend. So every quarter, they're now saving $300 million. So that actually helps the company a lot. And another thing to consider is that the stock was a relative bargain. Apple was trading at $700. It dipped to, $400. And Apple was thinking, we're confident in our company. Maybe investors aren't, but we have a lot of money. Our stock is cheap compared to how it's been in the past. Let's buy some back now. It really wouldn't make sense for Apple to buy its own stock when it was trading at, very high earnings per share at, $700 a share. It made more sense just to pay a dividend then. You're right. When a stock buyback has to be big. If it's small, it's usually just a waste of money. We'll never go for a stock buyback when it doesn't come with a big dividend. When the two are disconnected, that's a bad sign. So I hope this video is helpful for you, and you now know why stock buybacks generally are a bad thing and what you want to look for instead.